Welcome to Founders and Fortunes. I'm Ryan Austin, and today I'm joined again by Scott Hauck. Scott first joined me about a year ago when Legacy Capital was still a thesis with conviction behind it. Today, it is a more defined platform with two named vehicles, meaningful equity raised, substantial acquisition debt capacity advanced, and an active pipeline under LOI. The reason I wanted to do this follow-up now is that Scott is in the middle of building this thing in real time as a first-time fund manager. And I think there's real value in that. So this conversation is about what the first year actually required, the gap between interest and commitment, how the strategy got sharper, what had to mature behind the scenes, and what the next 12 months are meant to prove. Scott, good to have you back.
Thanks for having me back. Appreciate it.
Of course. So a year ago, we sat down for the first time. The raise officially kicked off for Legacy Capital, which is a private equity fund. Why don't you tell us a little bit, remind us what Legacy Capital is?
Yeah, so Legacy Capital is a lower mid-market private equity fund. We focus on buying companies that typically have base values or enterprise values between $5 and $50 million in the transportation logistics as well as the digital infrastructure spaces. Like you said, we have 10 million in deployable capital, and that's something that we've raised over the last year. We've also, through our partner at Forsman & Co., we've closed a $300 million debt facility that allows us to go much deeper into the acquisition space, more so than we had originally planned. We have 6 businesses that are currently in pipeline right now. Again, those enterprise values range anywhere from 20 to 100 million, and so things are moving. We're still kind of building the train as we go down the tracks, but we're continuing the equity raise as we look for some of these larger lower mid-market companies to acquire.
Yeah, excellent. And so let's start back. We'll go back in time, right? So a year ago, and you could be honest, when we sat down for the first time, where did you think Legacy would be by today? It was a massive undertaking. I've been with you along the journey.
Yeah. That's a loaded question. I was kind of hoping we'd be done with our capital raise by now, but in a sense, we're there with the debt facility that we've raised and with the equity that we've raised, and then all of the soft circling equity that we have with committed LPs. But in some ways, we're further along than I had anticipated, primarily in the acquisition space. So with the 6 companies we're looking at, as you mentioned before, we're building out 2 separate platforms. One is a general freight platform, and then the second one is a specialty freight platform. We have a thesis put together for each of those that shows how we plan to expand them into billion-dollar platforms. So in the acquisition sense, I feel like we're much further along than I thought we would be at this point. And it's fine to that we're still looking at acquisitions as we continue to raise the equity for the fund. I just thought it would be maybe the other way around, where we would be done with the equity raise and then start looking at acquisitions, but we're kind of doing them in parallel with each other, which is fine.
Right. A lot happened in that year,
Yeah.
right? I
Oh,
mean, even
yeah.
from the thesis, things evolved. We really niched down. We got some strong feedback from investors. We'll go deeper into that. But I guess the pivot is what actually unfolded over the last 12 months that you did not see coming as a first-time fund manager?
Yeah. So there were several things that happened over the last 12 months. So initially, we were targeting much smaller businesses, and we weren't really deep into the acquisition part of the business yet. Now we have the capital to start closing on those acquisitions. We also brought on board 2 investment banks. So we brought on Vortex Capital out of Zurich, Switzerland, and then we brought on Forsman & Co. out of California. And those 2 investment banks have been key in introducing us to additional family offices, additional investors, potential investors, even some institutional investors and debt providers. And through the partnership that we've built with those 2 investment banks, we've been able to mature our offering as a fund overall. So our documentation has been updated. Our approach has been completely updated. We've matured the offering to the point where we're now ready to take on, more savvy family office investments as well as institutional investments. So our data room is very clean, very very much ready for institutional capital. And our thesis as a fund, when we tested it with family offices both in the U.S. and in Zurich last fall, it resonated very well. Family offices love the space that we're playing in. They love that we're focused on lower mid-market companies that are more family oriented.
Yes.
And so we got great feedback from them. Again, we really matured our offering, and it's kind of led us down to the path of where we are today with looking at larger companies to acquire that have more EBITDA, which means more distributions for our LPs and for our investors. And just we've just become a much more sophisticated fund over the last several months.
So, what part of the past year proved harder than you had expected, and what made it hard?
So I think the maturity process of the fund was overall fairly difficult. I mean, we were getting feedback from, very sophisticated family offices and from, the investment banks that we had hired. And so that was a bit of a I mean, there were some growing pains involved with that maturation process, but once we completed that process and had a more sophisticated offering overall, then things started falling into place. New investors, new potential LPs, larger, interest from larger family offices. And then we also started to attract larger off market deals, which we currently have in the pipeline. And we're hoping to close our first couple deals here within the next 30 days.
Tell me about that process, both from the pipeline, and we'll get to the pulling the debt lever and how that increased. But do you have anything you wanted to add on that?
Yeah, I mean, part of the process of upgrading the fund included bringing on additional GPs. So Kevin Albert is one of our new GPs. He's been on for just less than a year, and he's got about 50 years of experience in private equities. I call him the godfather of private equity because he basically started the private equity practice at Merrill Lynch in the 70s. So the guy's got a wealth of knowledge and insight that he uses to help our fund. And then we have Richard Metzler that we brought on board, and Richard has been uh, super instrumental in helping us find off-market deals in the transportation logistics industry. He's got close to 40 years of transportation logistics industry experience and a wealth of knowledge. And then we keep him busy, and he keeps me busy. Yeah. So I know we brought on Ermina Stroud, and she has got close to 35, 40 years in the digital infrastructure sector. Uh, and then we also have Ryan and Sarah Meekum, who have a lot of industry experience in health tech and healthcare technology, which is the same thing. Yeah. So, I mean, not only did we build out the GP team, the board team, but we built out our senior management team. We brought you on board as the chief strategy officer for the fund. We brought on operations people. We brought on more sophisticated legal counsel. And then the investment banks that we're working with. So we brought on a lot of like really sophisticated advisors and third party groups that are helping us not only from like an investor onboarding standpoint, a strategy standpoint, but also from a fund operations standpoint. So things are really moving right now. I feel really good about how the fund has matured over the last year. I feel really good about where we stand with LPs and with potential LPs. And then I'm really excited about our pipeline of businesses. We're looking to deploy upwards of $325 million in capital to make these acquisitions over the next 6 months. So
Excellent. And let's go more into like the weeds a little bit. The reality of raising capital early and kind of what that process reveals from the standpoint of a first time fund manager. People say the first dollars are the hardest to raise, and from the inside, do you find that true? And if so, what made that true for you?
I think it's definitely true. And I think it really starts with your network. Like I have a great network, but my network wasn't really comprised of a lot of accredited investors, family offices, and that's why I reached out and started working with people like you, started working with Forsman and Co. People that had those relationships that I didn't have when I first launched the fund. I had a few of them, but I didn't have like a well built out network accredited or qualified investors, family offices. I didn't have any of that. My background is in operating businesses and growing businesses, building out the revenue engine for companies. And it's not in, my experience and my work history is not in raising capital. But I found the right partners that knew how to do it and are helping me through it. And I'm really glad that I did that.
On point.
I'm not opposed to like recognizing what my weaknesses are, and I know that I don't have a background in capital raising. So I went out and found people that have much more experience and much deeper networks than I do.
And where, in your experience now, where is that real line between investor interest and then the actual commitment? And when did you start to recognize that?
I mean, when we started building out our list of accredited investors and started setting up meetings with them, I mean, you're getting people that have anywhere from 100,000 to potentially up to $1 million to invest. A lot of them have their money tied up in other things, so they're waiting on liquidity events. And so that's probably the most frustrating part of reaching out and building relationships with these smaller accredited investors, these private investors, is that they have liquidity events. And of course they have their money invested, but they may say, "Hey, I'm interested. I want to put $500,000 into the fund. I can't liquidate those funds and have them invested until after I sell a commercial property, and that sale will go through in August." And they're like, "Okay, great. We'll follow up in July and August and see how that liquidity event goes, and see if we're still a good fit for you for your next investment." And so that can be a bit frustrating. That with larger check writers, family offices, larger qualified investors, they can write a check for 500,000, $1 million, and may have that in liquid investable assets instead of having it tied up somewhere else. And so it's a little bit easier with larger investors, And then the other thing with smaller investors is you have to stay in front of them. You have to keep them. You have to communicate with them almost on a biweekly basis, just to make sure that they understand where the fund is, where the capital raise is, where the acquisitions are in the pipeline and the due diligence process. So you have to kind of keep them up to date a little bit more. There's a little bit more hand holding, whereas the larger check writers can just write the check, and when they see results, they see results, and they don't really check in on a regular basis.
They get it. Yeah, they've seen the movie before. They know what to expect. And it
Yeah,
should maybe be mentioned too, one of the strategic choices that we made was to go after basically and set up a pipeline that brings in accredited investors on the smaller side while we were buffing up the platform, working on that. We spoke to a lot of families and they want to see some momentum first, right? We pulled the debt lever, and then we also started going after smaller private accredited investors to bring them into the fund. And so that's kind of what you're referencing there. And on that front, what questions came up? What questions came up over and over from investors, or what concerns that you got used to addressing that you wouldn't have thought otherwise?
right. Well, I'd say the three biggest were, what are the risks of the fund? You know, uh, what are the risks of me as an investor losing my money? What are the tax advantages of investing into your fund? But then also, like, the biggest question was, and we get this all the time: what am I, what are my potential distributions look like? And so we've resolved, we've been able to resolve and answer all of these questions by building out tools, calculators, and resources for potential LPs, so they can go in and they can say, okay, if I invest $500,000, I can see an estimated amount of distributions that I'll receive over the next 7 years, which is the life of the fund, and then I'll see estimated tax savings. I'll see everything rolled up together, and so that tool in and of itself has been huge, just to be able to answer those questions from a tax and from a distribution standpoint. When it comes to risk, we get that question all the time too, but it really comes down to what we're investing in. And the businesses that we have in our pipeline, we really do quality due diligence on each and every one of them. So we're doing deep
Big
background
time.
checks. We're doing buy side quality of earnings analysis. We're probably going deeper than most people do with M&As, but we're licensed, we're registered with the SEC, and we're audited every year. So we want to make sure that the businesses that we're buying are low risk, have great returns so we can provide distributions to our investors, and have a lot of upside. So we do really deep due diligence on each of these deals to make sure that we're buying the right companies. And if you look at risk from that standpoint, there really isn't a lot because the risk is really in what we're investing in. We're not going out investing in startup companies
Startups.
where you go out and you pick 20 startups and you hope that one or two of them makes it through. No, we're going out and we're buying 12 to 15 very well established businesses that have a lot of EBITDA, have great, great cash flow, great earnings, and a lot of upside where we can roll them up into, different platforms, build them up, and then over the course of 3 to 5 years, position them for strategic buyers. And then hopefully return at least a 5.5x multiple on invested capital for our LPs.
What part of Legacy Capital's story really resonated with potential LPs?
I would say the fact that we are not your typical private equity fund, that we don't come in and do a financial strip and flip of a business after we acquire it. We recognize that these lower mid market businesses are really the foundation of the American economy. There's a lot of them. There's a lot of them that need to exchange hands over the next 10 to 15 years as boomers look to retire. And so we're coming in and we're respecting what the founders and the owners of these businesses have built. We're not looking to come in and scrap everything and build and keep what we want from the businesses. We're looking to build on the foundation that already exists. These founders, these owners have built phenomenal businesses, and we just want to build on what currently exists, and then come in as financial partners, as strategic partners, and make their businesses even better. And we're doing that through partnerships with the owners and with the founders. We're incentivizing them to stick around for 2 to 5 years, depending on the business, to help us continue to grow that business. And we're providing them with earnouts, with rollover equity, and other incentives to help keep them and their senior management team involved, so we can partner together and build the business over the next 3 to 5 years.
What do you think emerging managers underestimate at the beginning of this process, including the version of yourself a year ago?
So I think a lot of emerging managers underestimate the ability to raise capital and to also build their acquisition pipeline at the same time. Building your acquisition pipeline as early and as fast as you can is going to provide more credibility to your fund. It's going to help people see exactly, from a tangible perspective, the types of businesses that you're interested in investing in or acquiring. And it's going to give you, like I said, that automatic credibility. Uh, it's also going to help you kind of think through the kinks and the things that need to be worked out through, you know, within your fund, through your fund documents, through your processes, your procedures with your staff and the third party companies that you're working with. So start building the pipeline as soon as you possibly can. If anything, if you're not able to close on those deals, if anything, it's providing you experience and it's providing that credibility to show that you're actually engaged in the buying process, the transaction process.
Excellent. And I think too, a year ago, Legacy was still, and it's a fund, it's buyout private equity fund, right? Today, it sounds more like an operating platform. When did that shift happen in your mind and then become part of the strategy?
Yeah, that's a great question. So, I mean, back in the fall, when we switched from sourcing smaller deals that were, doing $1 million to $10 million in revenue to the much larger deals that are doing 50 to $250 million in revenue, we built out a process for sourcing off market deals, and the deals that we were bringing in were in the larger, lower mid market category. They were stronger businesses. A lot of them had audited financials. A lot of them were just way more sophisticated than the smaller businesses we were originally looking at. And then we turned that into a whole process. So, and it's something that we monetized. So if we find businesses that we like, but we're not necessarily interested in acquiring them or they don't necessarily fit our thesis perfectly as a fund, then we can refer them to other private investors or to other funds that may be interested, and they pay us a referral fee. Or if we find out that they're not really interested in an acquisition, but they need some form of capital, then we can refer them to our lender base. And again, we receive a finder's fee or referral fee for any loans or lines of credit we're able to help generate for them. through that referral. So we've built like a deal uh, a deal sourcing engine that has allowed us to tap into the volume of the deals available on the market right now and the ones that are off market deals that should be available. Mostly managers that don't really have a clear succession plan in place, know they need to retire, have a wonderful business, but really haven't thought about how they would approach a sell of their business. And we come in, we explain our model, and we get them to sell to us. Uh, and so we've built that process out, which is then, turned into us sourcing much more robust, much more sophisticated deals that have more EBITDA, more cash flow, but then also have way more upside from a roll up perspective, you know uh, from a basically from an ability for us to build those companies up over the next 3 to 5 years and find strong strategic buyers to come in and buy those out, or to go take those platforms public.
What has changed in the infrastructure behind legacy that gives investors more confidence today than they would have a year ago?
I mean, just the systems and platforms that we're using as a fund have matured. We have, nav fund services that we use for onboarding that gives us like automatic credibility with LPs and with family offices, because that's a well respected name in the the fund back office and investor onboarding industry. We've also partnered with other people and brought on tools to help with due diligence, and in some cases we've built our own tools. So something that we built out recently was a tool called Arendelle.io. It's currently in closed beta testing, and we're using that for due diligence workflows and for data rooms. So it's live. We're able to like plug all of our deals into that, upload all documents into the individual data rooms, assign to each of those deals, and then it's got workflow capabilities, so you can assign different projects and different items to certain people within the platform. And so that's helped us become more sophisticated with our due diligence process, and working with third party providers like QAV analysis teams, legal teams, teams that do background checks on the businesses that we're looking to acquire. But then it also allows us to integrate everything on the sell side too. So the sellers have one portal they can log into to see all of the documents, to upload documents, and then to also build out workflows so we can pass things back and forth between the sell side and the buy side during due diligence.
How do you balance fundraising with the actual work of building the fund, building these platforms, building a pipeline?
I mean, I work 12 to 16 hours a day. So like during the day, I'm meeting with potential investors, with family offices, with current investors. I'm also meeting with all of the sellers that we're buying companies from, and managing all of the operations on the due diligence side, making sure that things are running smoothly with our Q of E third party companies, with our background check companies, uh, that all of the legal items are flowing properly through due diligence. And so that's what I did with Arendelle.io. Once I turn it into a multi-tenant environment, and start or complete the closed beta testing, then we can start selling it to you know other buyers and brokers to use for their M&A purposes as well.
Something I do want to touch on too is to give a little bit more or shed some light on legacy freight holding and
Mhm.
legacy specialty freight holding.
Sure. Yeah. As we started building out the process, the deal sourcing engine that we have in place now for Legacy Capital, we started seeing a lot of deals out of the Milwaukee, Chicago corridor. And we started finding deals that complemented each other. So, for instance, one was general freight, dry age, and then there was one that was more refrigerated trucking and general freight. Then there was one company that we found that did something completely different in the trucking space, but also had a brokerage attached to it. And we started seeing that these businesses didn't have to be purchased or acquired as standalone companies, but we could acquire them and then roll them up into with these other businesses, and they could complement each other on the services that they offer in transportation logistics. And then we could add in the brokerage side of things. And the plan there is to then, eventually turn it into a national freight carrier. So start or continue to buy and roll up businesses on the east and west coasts, and then eventually turn that around and sell it to another national freight carrier or take it public, and then 8 to 10x our original return. With legacy specialty freight holdings, we're looking at two businesses out of the Houston area right now that that do oversized, overweight transportation freight for companies like Blue Origin, for NASA, for SpaceX. Then they also do a lot of things for the digital infrastructure space. So they do data center shipping, or freight. And this is not something that's easy to replicate. So these businesses obviously go for a bit higher premium than what we've spent or what we're acquiring these general freight companies for. But they're shutting down entire freeways, and they're moving power lines, and they're getting cities and county governments involved. And these are things that are taking months to ship, not days or weeks. And so that's going to be our second thesis, is the specialty freight platform. And so we'll build on that. We'll continue to acquire companies in that space, and then eventually turn them into, a national specialty freight carrier, potentially international specialty freight carrier, because a lot of them already do a lot of international, oversized, overweight freight. So we're gonna leverage that and build on that. And both of those platforms, by the way, are going to complement each other. So, they're going to be able to refer business back and forth. Um, if something doesn't quite fit the oversized, overweight arena, then they can get one of their sister companies or one of the other portfolio companies to manage the freight for that. So there's a lot of synergies that can be built out between the two platforms, and then obviously there's a lot of growth opportunity within the platforms themselves.
And you kind of answered this, but what is the long-term vision for Legacy beyond this current fund number one? You answered it. I mean, it's a pretty big undertaking for a 7-year fund, right? But we're already making great progress with the thesis and then also the companies that are currently being acquired. What do you think is next? What's fund two look like?
So Fund Two, I mean, it's obviously going to have, a much higher. It's going to be a much higher raise, both from the equity and the debt side. So right now we're targeting a complete fund with $450 million in total capital on the equity and debt sides. We'll probably target $1 billion for the second fund. And there's going to be, again, another transportation logistics component to it, probably a specialty freight component. But we'd like to make it a little bit more agnostic from an industry standpoint. So bring in some additional digital infrastructure businesses, SaaS-based companies, actual data centers, and then also potentially look at fintech and some other sectors that we have a lot of experience in.
And just kind of looking forward and reflecting on, what this chapter has taught. What do you understand today about this business and about yourself that you did not understand a year ago?
I mean, things take time. Building those relationships, they take time. They don't come right away. Like, especially with larger investors, family offices. Like, you really have to get in and nurture those relationships, understand their business models, understand how they operate, and then try to stay top of mind until you're either able to have them write a check or call the capital that they've committed to. So like, really building out those relationships, understanding that it's a long-term game, and making sure that you do everything just right at every different level. Well, I mean, at every respective level. So with the lower mid-market companies that you're looking to acquire, the due diligence process, the deal sourcing process, make sure that you're aligned with, that your fund is aligned with potential LPs and with family offices, and then, building those relationships to the point where they become investors, and then through your hard work on the fund, you make them happy investors by returning capital quickly, and providing a steady stream of distributions and tax savings.
And what should the first $10 million of equity we raise ultimately prove to the market about Legacy Capital?
I think it proves that that the thesis is real. That's very viable. That we are who we say we are. You know, my expertise lies in building businesses, and it turns out that we're pretty good at raising capital as well. So, you know, it proves that if you keep going, keep building those relationships, you know, you can hit your equity and your debt targets from a fundraising standpoint.
Looking forward over the next 12 months, what would success look like?
Closing out the fund, you know, I'd love to see if we can close out the equity side, the whole, you know, capital raising side of the fund within the next 7 to 9 months, and then within the next 12 months have, you know, 6 acquisitions behind us, but then have another 6 acquisitions that are in the pipeline, potential acquisitions in the pipeline. So, you know, by the end of 2027, I would love to see us with 12 to 15 portfolio businesses. You know, we've deployed most of our capital to acquire the companies, and then we're doing the fun stuff, which involves just working with each of these portfolio companies to build out their businesses from a strong partnership standpoint.
Um, Thank you so much for joining me, Scott. I appreciate it and look forward to knocking this one out of the park for the remainder of the year.
Yeah, me too. Thanks for the time, Ryan. Really appreciate it.
Thank you.